There's this classic piece of pub talk, a question that comes up almost every single time people start debating the Italian economy. The argument goes something like this. To fix the national accounts, why don't we just sell off all the family jewels?
Okay, let's dive into this. What if we actually just sold everything to pay off the debt? It's a highly seductive economic myth, isn't it? I mean, the idea is beautifully simple. You take these massive state-owned companies, you sell them off to private investors, and boom, you wipe out our financial problems. But does the math actually add up?
Well, first, we really need to understand the sheer scale of what we're up against here. 3.1 trillion euros. That is the crushing reality of Italy's public debt. This colossal figure absolutely sets the stakes for our entire analysis today, and we have to keep that massive number in the back of our minds as we evaluate what the state's assets are truly worth.
Section 1. The state's hidden treasure.
So who really controls the biggest Italian companies? Believe it or not, it's the state. The government's assets are essentially divided up into two main drawers. On one side, you've got the Ministry of Economy and Finance holding these massive direct stakes in giants like Enel, Leonardo, and Poste Italiane. Plus, they have almost total control of RAI. And then on the other side, you have the CDP, managing heavyweights like Eni and Fincantieri. It is an incredibly vast, dense web of state control over Italy's most famous brands.
But what is all of this actually worth in cold, hard cash? Well, if we only look at the state's assets that are currently listed on the stock exchange, the FTSE MIB, they amount to nearly 100 billion euros. That is a massive nest egg. And actually, if you factored in the non-listed entities, like the state railway system, that valuation would absolutely skyrocket.
And this brilliantly illustrates a crucial point. These companies are absolute cash cows. The state collected 3.3 billion euros in dividends in 2025, and projections show that's going to grow to 4.3 billion by 2026. Now, sure, the state bleeds roughly 100 billion euros a year just paying interest on its massive debt, but these billions in growing, recurring dividend revenues, they provide an absolutely essential cash flow to help soften that blow.
Section 2. The mirage of selling everything.
So let's ask a very simple, practical question. How much of a dent would selling actually make? Well, the mathematical reality is frankly devastating. Even if the state sold absolutely everything and aggressively raised 150 billion euros, that only covers a mere 4 to 5% of the total debt. The massive 95% remains completely intact. You literally lose your best assets and the debt barely even feels a scratch. To truly understand how we got here, we kind of have to look back at the history of the entrepreneur state. Back in 1933, the IRI was created to save the economy from the Great Depression. Then, decades later, to meet the strict requirements for entering the euro, the 1992 Amato government transformed these massive state entities into joint stock companies. That actually triggered waves of privatizations that brought in 152 billion euros by 2007. Yet recently, we've seen the exact opposite, the state stepping back in, rescuing Monte dei Paschi and managing the complex transition of ITA Airways.
Because, historical mass privatizations are rarely fairy tales. Take the highly symbolic Telecom privatization in 1997. It was pitched as the mother of all privatizations, but today it serves as a stark historical warning. The company ended up in private hands, severely undercapitalized, heavily loaded with debt, and heavily downsized over the years. And ironically, it has now been partially reabsorbed right back into the public orbit via Poste Italiane. It is a perfect example of what can happen when vital assets are stripped and poorly managed.
So practically speaking, why would a mass sell-off fail today? First off, basic market mechanics. You literally cannot just dump a 30% stake in Eni onto the market. The sudden flood of shares would instantly destroy the stock's value before the sale even finishes. Second, the government's current plan to sell just 20 billion euros worth of assets by 2026 is already viewed by many as highly ambitious. And third, selling means instantly and permanently surrendering over 4 billion euros a year in growing dividend revenue.
Section 3. National security and key sectors.
Let's move to a deeper issue here. Sectors like energy, defense, and telecommunications are simply too sensitive to leave entirely to the free market. While Italy debates this hypothetical mass sell-off, look at what neighboring countries are actually doing. France literally went in the exact opposite direction, spending 9.7 billion euros to completely nationalize EDF, their major energy producer. Germany actively buys stakes to protect its national interests, stepping in to save Lufthansa during the pandemic and maintaining a really firm voting grip on Volkswagen. This highlights a really core tension. You see, the goals of the state and the goals of a private investor are inherently different. A private investor, they want to maximize shareholder value. The state, however, has to prioritize things like national energy security and employment. We actually saw this play out during the recent gas crisis, where the Italian state had to prioritize energy security over stabilizing Enel's stock price. Public control acts as a vital safety net in these foundational sectors, even if it does introduce some political volatility.
Section 4. State dividends and private investors. Now, companies like Poste Italiane and Eni are famous for being incredibly consistent dividend payers. I mean, Poste yields around a solid 6%. So if you, as an everyday private investor, are willing to accept the political risks we just discussed, you can actually harness these dividends effectively. How? Through a DRIP, or a dividend reinvestment plan. This is a brilliant strategy that automatically reinvests your dividends to buy fractional shares. It completely eliminates the friction of manual reinvesting and lets you fully maximize the incredible power of compound interest over time.
Section 5. The only solution to the public debt. So, getting back to the big picture, how do you actually defeat a multi-trillion euro debt? No quick fixes here. It requires 3 structural steps. Step 1, you absolutely have to fix your budget deficit structurally. Step 2, you need to generate real GDP growth that actually outpaces the interest you pay on the debt. And step 3, you retain and grow your dividend-generating state assets. If you don't implement long-term structural budget management, selling assets is practically useless. Why? Because the debt will simply return exactly as before, only this time you won't have your best companies left to help you out.
So the crucial point is this. We are left with a pretty provocative thought shared by many economists today. What if the state should invest even more instead of selling? Think about it. Instead of viewing state assets as some kind of ATM to be drained for a temporary fix, perhaps the future role of the state is as a strategic investor, actively generating wealth and ensuring security. What do you think is the right balance? Thanks so much for exploring this explainer with me, and definitely keep questioning those easy economic myths.